Gold is surging today, on Saturday, July 18, 2026, and the reason is more alarming than most investors anticipated. The catalyst is something markets are now calling the Iran war premium, a measurable risk adjustment baked into commodity prices as geopolitical tensions in the Middle East continue to intensify. Brent crude has already crossed $106 per barrel, and with US-Iran diplomatic talks in a state of collapse, safe haven demand for gold has spiked sharply. But here's what makes today's move genuinely significant: this is not simply a flight to safety. The Iran conflict is now threatening to reignite inflation, which in turn is forcing markets to rethink Federal Reserve interest rate policy. Gold is climbing today not just because investors are frightened, but because fear itself is reshaping the entire monetary policy outlook for the United States. To understand today's gold move, you need to know what has been building over the past several months. Back on March 26, 2026, crude oil was already approaching $105 per barrel after Iran flatly rejected a U.S. proposal to end the conflict. That rejection sent commodity markets into a fresh round of repricing. In early July, President Trump issued a pointed new warning directed at Tehran, and those statements initially strengthened the US dollar and actually pushed gold lower, a classic safe haven reversal where dollar strength temporarily outweighs fear. But that dynamic flipped. By July 17, gold was climbing again, and today, the 18th, the move is accelerating. What changed? Markets have concluded that the Iran risk premium is not going away, and that the US dollar strength alone cannot suppress gold when inflation expectations are rising simultaneously. The Iran war is now a persistent macro variable, not a temporary shock. The term Iran war premium refers to the additional value that investors assign to gold when the probability of a broader regional conflict in the Middle East rises meaningfully. Iran is one of the world's significant oil producers, and any escalation that threatens the Strait of Hormuz, the narrow waterway through which roughly 20% of global oil supply passes, could send crude prices dramatically higher. As recently as late March 2026, financial analysts were openly discussing the possibility of oil reaching $150 per barrel in a worst-case scenario. At those levels, the inflationary shock to the global economy would be severe. Gold, as a store of value with no counterparty risk, becomes an obvious destination for capital under those conditions. The premium is not speculative noise, it is a rational, historically grounded response to a very real supply disruption risk. Here is where today's story becomes genuinely complex, and where most casual observers get confused. Normally, when the Federal Reserve raises interest rates, gold falls. Higher rates increase the opportunity cost of holding gold, which pays no income. So why is gold rising today in response to increased rate hike risk? The answer is stagflation anxiety. An Iran-driven oil shock would push U.S. inflation higher at precisely the moment when the Fed had been preparing to cut rates. Markets had been pricing in Fed rate cuts through much of 2026, and those expectations were already pushing gold higher. Now, that cutting path is being unwound. The uncertainty itself, the fear that the Fed may be forced to hike rather than cut, is creating the very anxiety that sends capital flooding into gold as a hedge against policy error. It is a feedback loop, and as of July 18, 2026, that loop is very much active. Let us look at the numbers specifically. Gold rallied convincingly above $4,300 per troy ounce in mid-June 2026, driven at that point by falling oil prices which had briefly revived hopes of Fed rate cuts. That move stalled, and by early July gold had pulled back below $4,200 as inflation fears reasserted themselves and the dollar found footing. Today's climb, powered by the Iran war premium, is making another attempt at the $4,200 level and pushing toward $4,300. This is the range that active traders and institutional investors are watching most closely right now. A sustained close above $4,300 would represent a meaningful technical breakout and would likely attract fresh momentum buying. If the Iran situation deteriorates further and oil climbs beyond its current $106 per barrel level, the case for gold testing entirely new highs becomes considerably stronger. You simply cannot understand today's gold rally without understanding what oil above $106 per barrel means in practical terms. When Brent crude trades at this level, the effect is felt across the entire economy. Petrol prices rise, haulage and logistics costs increase, and food supply chain costs expand. For the United Kingdom, which imports a meaningful share of its energy, sustained crude above $100 adds direct inflationary pressure at the consumer level. For the United States, where the Federal Reserve's dual mandate requires managing both price stability and employment, oil at $106 makes the path back to the 2% inflation target considerably more difficult. Every tick higher in crude oil is therefore a tick higher in the probability that the Fed delays or reverses its cutting cycle, and every uptick in that probability adds to the case for holding gold. This is why commodity traders are watching every development in US-Iran relations with such intensity right now. For investors watching this unfold on July 18, 2026, there are several concrete and immediate implications. Portfolios carrying gold exposure, whether through physical gold, gold-backed exchange-traded funds, or gold mining equities, are benefiting from today's price climb. The revival of Fed hike risk is simultaneously creating headwinds for both bonds and equities, which reinforces gold's appeal as a portfolio diversifier rather than merely a speculative play. It is also worth noting that the Canadian dollar, a commodity-linked currency, is currently showing a bullish bias against the US dollar, with analysts at Scotiabank focusing on the 1.3981 level as a near-term target. This tells us that gold is not moving in isolation today. The entire commodity complex is repricing geopolitical and inflationary risk simultaneously. Investors who have been waiting on the sidelines are now watching very carefully to see whether today's move has genuine momentum behind it. Looking forward from today, there are 4 specific variables that will determine whether gold sustains this climb or gives back its gains. First, watch for any breakthrough or breakdown in US-Iran diplomatic channels. A genuine resumption of talks could quickly unwind the war premium. Second, monitor the upcoming US Consumer Price Index releases, which will confirm whether oil-driven inflation is already feeding through into the broader economy. Third, pay close attention to Federal Reserve communications for any explicit shift in language around the timing of rate changes. And fourth, watch gold's ability to hold above $4,200 and push toward $4,300 with conviction. If oil remains above $106 and Iran tensions persist, the gold bull case is robust. If diplomacy surprises to the upside and oil retreats, expect today's gains to be tested. The situation remains genuinely fluid as of this Saturday. Today's gold move is not background noise in the financial markets, it is a precise and logical response to a specific and serious combination of forces. An unresolved Middle Eastern conflict, oil trading above $106 per barrel, a Federal Reserve being pulled away from its rate-cutting path, and a global investor community seeking shelter from stagflation risk. The Iran war premium is real, it is quantifiable, and it is driving capital into gold right now on July 18, 2026. Whether you are an active investor, a long-term saver, or someone simply trying to make sense of what the global economy is telling us, the message from gold today is unmistakable. Uncertainty is elevated, central bank policy is under pressure, and traditional safe haven assets are in demand. Keep a close eye on the Iran situation. It remains, without question, the single most important geopolitical variable for commodity markets heading into the second half of this year.